Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now, someone never will have an encore career. Claudia Sahm is the anchor to our Jobs Day. We're honored she could be with us. In the revisions coming up here, Claudia, how aging is our population?
So, it's an ongoing process. We have baby boomers who have moved into prime retirement, and the demographics on the aging side move very slowly. The demographics that have been moving very quickly have been on the immigration side. That's really what's been pulling, say, the payroll numbers around. But aging is happening, and that's a reality that's marching along right with these every month of data we get.
Claudia, every time we talk about the labor market, what we now also have to incorporate into that discussion is AI. Quite simply, is AI a net creator of jobs or net destroyer of jobs? What's your view at this early stage?
So we're at a very early stage, and with AI, how this transforms our labor market, and it will transform our labor market, is going to depend on the leadership that we have in our businesses, our civic institutions, and our government, right? AI is not in control. We are in control. It's a technology. It's a technology that has a lot of potential. It could go in a lot of different directions. It's not just about automating out workers. It can also be about empowering workers and making them, more valuable, higher paid, new opportunities. But we don't know yet where it's going. And so there's going to be decision makers who really, shape the future of AI in the workforce.
Claudia, your research note really emphasizes the revisions. So last time we got a 130 pop. What happens to the markets if we go back to back plus 100 numbers? No one's expecting that, are they?
No. Yeah. And I think what we were looking for as we came into this year was signs of stabilization in the labor market, right? Things had been slipping since mid-year, and we saw job creation really hit a wall in the middle of last year. And so we're just looking stabilization, right? January was more than stabilization. 130,000 payrolls, unemployment rate ticking down at 10. That's getting better. We'll take that. Right? That would be awesome. But even if we had some downward revisions to January and we have a February payrolls number that is positive and kind of has some lift to it, it could be 50,000, 40,000, something in there, and the unemployment rate stays stable, that's going to check the box on stabilization, even if we get some downward revisions in prior months.
So real quickly, wages, how do you think wage environment is right now?
So we have seen, wage growth slowing. We've seen a moderation. It's been very gradual, which is consistent with some softening of demand for workers. But the wage numbers, including last month, have still been, they've been pretty solid. And when we think about what's happening right now with gas prices and the energy shock coming to American consumers, those wage growth numbers and the jobs are so important, because this is the key buffer that Americans have for these higher costs, is to have a paycheck that's getting bigger and being able to find work if they want work. So that's a really critical backdrop.
Claudia Sahm with us, New Century Advisors, and we're going to continue with Dr. Sahm here after we see the jobs report. Jennifer Lee of BMO Capital Markets and Nadia Lovell, UBS, will join us as well. Into the jobs report, futures, negative 36. Good morning.
I'm Alexis Christoforous, and these numbers just crossing the Bloomberg. Now, the Labor Department says the U.S. economy lost 92,000 jobs in February. That is worse than expected. We were looking at an additional 55,000 jobs. And of course, this is compared to January, when we added 130,000 jobs. The unemployment rate ticking up to 4.4%. The estimate there was 4.3%, and the prior month was 4.3%. Checking wages month over month up slightly to 0.4%. 0.2%. Estimates were for 0.3%, and earnings year over year also a bit hotter, 3.8% versus the 3.7% expected. But again, the headline here, the economy lost many more jobs than expected, 92,000 in the month of February. Estimates were for 55,000. We also just got retail sales numbers out for the month of January, and they were down 0.2% versus the estimate of 0.3%. As for market reaction, it is swift. The Dow futures now down more than 400 points. S&P futures off 64. Guys?
Alexis, thank you so much. 10-year yield comes in with a vengeance. 4.17 is now a handle 4.10. That's price up, yield down, and futures negative 40 to negative 60 here. Retail sales pretty much on track with a constructive revision. But Paul, I'm just going to, before we go back to Dr. Sahm, change in non-farm payrolls, negative 9.2. 2-month revision, negative 6.9. I'm eyeballing it, Paul, but I think that's a negative 161.
Yep.
Combined.
Yeah, that is a sharp reversal in the short-term labor market here. Again, minus 92,000. The consensus was for positive 55,000, and that 2-month payroll revision, negative 69,000, Tom. So that is the big numbers across the table.
Claudia Sahm with us as we continue with all of her good work here. These are the kind of numbers, Claudia, where amateurs like me go, okay, that means diminished GDP. Is that correct? That all of a sudden's back to a lesser real GDP where we're on the Sahm recession watch?
So not necessarily, so clearly these numbers from February are not in checking the box on signs of stabilization in the labor market, right? We're losing jobs. The unemployment rate ticked up. This is not a good sign. This actually sits pretty consistently, especially if you look at the last 3 months, with what we saw all of last year. The U.S. economy last year created almost no jobs on net, right? And at the same time, consumer spending increased, business investment increased, GDP rose for the year on trend, right? We can talk about concentration, we can talk about what sectors it's in, but we have already been for a year in a jobless expansion. So unfortunately, what the February data, what this latest labor market data suggests is that's still where we're at. Right. And we had been looking for signs that hiring was picking up. And, the January employment report gave some signs of that.
Yep.
January still is a really strong number, even with down revisions. It's close to 130,000 still. But I mean, clearly to lose 90,000 jobs on net in February is a real problem.
Claudia,
we're not creating jobs.
Yep.
It's that question, is it a problem? That's a whole separate, and this has been a really difficult conversation to have, but we've been in this for well over a year now.
So, Claudia, what do we know about the supply of labor? We know that this administration has effectively closed down the border, reducing supply of labor to some industries, whether it be housing, construction, agricultural, hospitality. What do we know with a year's worth of data here as to the supply of labor?
Well, the estimates with immigration come in. It takes some time. We have, updated estimates from the Census Bureau. We have updated estimates from Congressional Budget Office. They're pulling in a lot of different pieces of data. These are still in flux, but it is very clear directionally, and it's also very clear in terms of magnitudes. These are large downshifts in immigration, and immigrants have been kind of on the margin additional workers in recent years. So it does, directionally, this makes sense. And I think that is important to keep in context. These shifts in job creation, going from, hundreds of thousands of jobs created on net not that long ago to not creating any, and if maybe even destroying jobs on net in the U.S. economy, that is a dramatic shift. And the unemployment rate has drifted up.
Yep.
Right, we're at 4.4%. Yeah. So, we have to keep the magnitudes and the drama on the payroll side. It's not just about weakening demand. It is the supply, and that's a policy choice. But keep an eye on the unemployment rate has drifted up, and there is still a problem. This is not just about supply. We don't have enough demand for workers.
I mean, Claudia, to your point on a flat economy, I just did a 3-month moving average, folks, in the back of my HP12C.
Oh, yeah.
And the bottom line here is we've generated 5,660 jobs over the last 90 days per month. I mean, I've never seen it. That's like a flat economy. I have Claudia quickly here. I mean, there's a lot of negative statistics, Claudia. What does the Fed do with this information if labor matters?
So they're watching all of this very carefully. I think the unemployment rate really does sum a lot of this up. The fact that, the unemployment rate did tick up. We're still at low levels, but it has been drifting up gradually. They're going to keep, this returns some attention to the downside risks to employment, right? This is all about the employment risks, the inflation risks. Today brought some of those employment risks back into focus, but this is still largely a labor market that looks like it's working relatively well. Not a recessionary dynamic, but a very unusual dynamic.
Okay, it's unusual, but I mean, there's a lot of people flat on their back in this country, Claudia, saying cut interest rates. If Waller and Company, Goolsbee and Company, Hassett and Company, if they cut interest rates, does that help the labor economy, or is it now removed?
Cutting interest rates is a way to stimulate demand, whether that's, consumers going out, making bigger purchases. They have to take out, on their credit cards, buying a home, businesses making an investment in equipment and software. It's a channel that can help. It is not all powerful. It's a very blunt tool. But, that's the tool the Fed's got. And it is very clear from this Powell Fed, they will defend the labor market if they need to.
Dr. Sahm, thank you so much for supporting us in your note and all your work with us. Claudia Sahm with us this morning with New Century Advisors. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
A wonderful brief here from Eric Van Nostrand joining us in studio, Chief Investment Officer at Lazard. What have you changed in your call in the last 7 days? I mean, I'm sitting here, it's like the Tom Keene Employment Act. It's like the news flow's crazy. But what are you writing differently now than 8 days ago?
Well, let me first say I'm a big supporter of the Tom Keene Employment Act, so I'm glad that's working for you.
Anyway, Alexis doesn't agree with you, but that's different.
I think the sharpest investors are the ones who are willing to change their minds when the facts on the ground change. And what we've seen over the last 7 days is a pretty dramatic rethinking of the global supply picture for energy in particular. We've seen a staggering surge in the price of oil as traffic in the Strait of Hormuz has slowed down as dramatically as it has. But I still think markets are thinking of it like a short-term disruption. I think there's still a little bit of recency bias from the 2025 Iran episode, which is fundamentally very different from this one. And I still don't think markets have fully appreciated the cost to global growth, to global supply chains, and to domestic inflation here in the United States from a persistent disruption of the straits.
So the underlying economic data in the U.S. is still generally very healthy.
Yeah.
When you look at GDP growth, we'll get the jobs data today, inflation. But this situation in Iran, I guess the market is kind of telling us we're prepared to look through it to the other side. Is that a fair assumption here? Or at what point does it become problematic? Is it 3, 4, 5, 6 weeks, that kind of thing?
Well, I think you're absolutely right in terms of what the market is discounting. The market is trying to look through it, even though these oil price moves look big. The stock market moves this week feel painful. In the grand scheme of things, U.S. equities are just at the bottom of the range they've been since October. Yeah. Oil's still off its heights since the Ukrainian invasion, but I think that relative sanguinity, that relative calm, is out of line with the level of fundamental risks in the backdrop here, and that's why I think paying close attention to traffic in the Gulf is going to be very important.
Eric Van Nostrand with us here. We're going to continue. Jane Foley over at Rabobank just tweaked euro. She goes weaker euro from a 117 down to 116 is her view. Right now, euro with a really difficult week, 115.62 with DXY pushing up against 100. I mean, that's consensus gets a view here. Oops, it's wrong. Like the massive weak dollar call doesn't look so good right now.
Right.
What is consensus in economics into this jobs report, into retail sales? What's a consensus call in economics where the Van Nostrand radar is up?
Well, I think you got to separate the structural and the cyclical here. And I think the structural context coming into the Iranian episode and coming into the jobs report today is that the U.S. economy has been, I like to call it more concentrated than it's been really in living memory. The way consumers spend, it's really driven by the top of the income distribution. The way businesses invest, it's all concentrated in AI data centers. We have a very concentrated set of demand factors on both the consumption side and the investment side in the U.S. And that's contributed to strong overall growth, but it's also more fragile than this level of economic growth normally is. And that's why X factors like this energy shock, the risk of a slowing labor market, and that's why we'll be watching today's report very closely, all threaten to disrupt that generally strong growth we've seen year to date.
This K-shaped economy, this K-shaped consumer, it's been with us for a long time. Is it problematic? I know it's problematic for the people on the lower end of the K, but for the overall economy, the numbers that we get on our eco screen, they seem pretty darn good. But structurally, can this economy continue with such a disparity?
Yeah, so the reason I think it's problematic for a lot of reasons, not least because of the large portion of Americans who aren't seeing the income growth that one would expect from this level of aggregate economic strength. But it's also worrying because the most persistent growth, the growth we can have the most confidence in as macroeconomists, is the broadest growth. And when it gets concentrated like this, it's more prone to disruption from geopolitical shock, which we've had an awful lot of lately, and from supply constraints. And I think this particular geopolitical shock is going to increase those supply constraints.
Before the jobs report, 16 minutes away from all that data, Claudia Sahm will be with us. Let me look at the list here. I don't have Nadia Lovell will be with us, UBS on the equity markets. Jennifer Lee from BMO Capital Markets, just wonderful. Benjamin Laidler, who has the mother of all calls. A guy named Kevin Hassett's going to stop by, I believe, talking to John Farrell as well. Austin Goolsby late in the show today. Right now, Eric Van Nostrand with us. Okay, I'm going to get you in trouble. There's a guy, Adam Posen, at the Peterson Institute who did a co-write with a guy named Orzag. And they have basically suggested inflation will be more persistent. Do you agree with Lazard's Peter Orzag that we are going to see a persistent wage inflation? We are going to see a persistent overall inflation, which is not in the markets at this time.
I'm happy to give you a list of topics on which I disagree with my boss, but on this one, Peter and I are in the same place. I think the markets are generally far too calm about the inflation picture. They've been kind of lulled to sleep a bit by the fact that the headline CPI has calmed down. And, Peter made that call before the episode this week. I think the oil disruption we're seeing is obviously going to juice the inflation numbers in a meaningful way. But here's the key point, Tom. It's not just the impact of the oil shock that we've already seen.
Right.
It's the fact that the broader supply picture bleeds through to a much broader global constellation of goods and services and inflation. And to my mind, really increases the risk of upside price growth.
And Peter did brilliant supply analysis here 2-3 years ago on COVID as well. So with the jobs report, last month was oops. Well, that was positive. Are we going to get another oops report here where you got a 3-month moving average, which is oops, better than the gloom crew?
Well, I think I heard Chris Waller just tell your colleagues he expects January to be revised down meaningfully. I do think January looks like a pretty significant upside outlier in the pace of job growth we've seen recently. I think it's very important here, Tom, to balance the supply constraints that have been pulling job growth down and not confuse them with slowing demand, which I think is one of the bigger forward-looking worries we have right now.
The Supreme Court recently struck down the IEEPA tariffs, but we still have a lot of tariffs out there.
Sure.
But the market, again, seems to have looked through, generally after that April timeframe last year, looked through these tariffs. What is the economic impact of these tariffs, do you think?
I think the markets have looked through the tariffs because the inflation data has given them permission to. Because the inflation data so far has been much softer than most economists, including me, by the way, would have expected given the magnitude of tariffs we've seen. Now, that's much more likely to be a delay in the tariff impact than a miss on the tariff impact. And that's part of the reason we expect an elevated risk of hotter inflation over the course of this year.
You were the Assistant Secretary of the Treasury for Economic Policy under President Biden. What did you learn there? I mean, a fancy guy like you with all your work at BlackRock and now at Lazard, you wandered by Yale to get pizza and a law degree. Wonderful work out of Pennsylvania. What was the biggest lesson learned in your public service at Treasury?
I mean, I came away from that job deeply, deeply inspired by the manner and the courage with which public servants, not just in the Biden administration, but including the career officials that worked closely with us throughout, were able to balance economic rigor and understanding the intellectual arguments with understanding the way they affected human beings.
So if we pop 3 months, this is like an Orzak question. If we pop 3 months moving average, sub 100,000 non-farm payrolls, you're telling me that's politically acceptable?
Absolutely not. I think the slowdown in job growth we've seen over the past couple of years is evidence that it's evidence that some of the shifts we've seen in the way the labor market's been able to grow, some of the tighter constraints imposed on supply by immigration policy in particular, are resulting in lower growth than the United States would otherwise be able to deliver.
This is like gossip with Taylor Swift. What's the thing
That's
you
the first time I've gotten that one.
What is the thing you and Orzak are most not on the same page on? What do you argue about?
Now you are going to get me in trouble. I think the conversation with Lazard, we always describe the conversation with Lazard as being about contextual alpha, which is we do our quantitative, rigorous work, but we put it against a backdrop of what's going on in the geopolitical environment overall. And I think that mix of qualitative and quantitative is really at the center of how we develop views. But also creates a lot of debate and creates, I think a lot of open questions about whether the Supreme Court's ruling on tariffs creates more or less uncertainty. I think right now, I think it's a good thing they did that, but I think
we'll sum it up on the back of a 3x5 postcard. Do we get solid GDP out of your contextual reality?
I still think this year is more likely than not to deliver above potential growth overall. But there's a lot of risk, Tom, and your listeners need to pay close attention.
Alexis, what did you say last? Like ambiguity, grammatically?
Grammatically ambiguous.
Ambiguous.
Ambiguous, yes, thank you.
There's nothing ambiguous about Lazard research. This has been great. Eric,
we try to be grammatically precise.
Eric Van Nostrand, thank you so much on this Jobs Day. He is with Lazard Asset Management. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We start strong with Kevin Gordon, with Charles Schwab, working with Lizanne Saunders. What's the place like if Kathy Jones retires? I mean, it's not good. I mean,
I know we're sad,
everyone
but
wears
she's
black.
totally earned it. But personally and professionally, we're all sad. But we're happy for Kathy, though.
It's a real huge commitment by her to Schwab. And
awesome.
Our commitment to you is you people are the kings of patience. Just as a view from 60,000 feet, there's a war. Do you change your asset allocation?
In response to it in a knee-jerk way, no. I mean, our message around any sort of geopolitical conflict has always been that. Not to say that it doesn't matter or that you won't start to see any impact from it. And I do think that, to the points that you were all just making around some of these moves in prices, and this is an environment where rate of change and level both matter. Yep. Typically, there's sort of some distinction between the two. But I think from a consumer perspective, but also eventually maybe from a business confidence perspective, there is potential for this to sort of shake things out a little bit more. But I mean, this is a day-by-day developing situation. I mean, we're sort of one ceasefire announcement away from everything sort of just reversing sharply and aggressively.
Yeah, exactly right. So what is the message to the Schwab clients? Because I'm sure the phone calls are coming in fast and furious.
Yeah.
And you guys go speak to your big room full of Schwab clients, and before you even get into your prepared remarks, they're like, what do we do?
Yeah, I mean, the message around, it always sounds like some sort of boring message around diversification, but that really is the best way to sort of hedge this, lowercase h hedge. If you think about even coming into this year, before this started, you were still seeing that international outperformance relative to the U.S., but now it's kind of reversing a little bit where, of course, because of the exposure that some other countries, mainly in the European region, but also Asia, that they have to the Middle East because of energy and oil, the U.S. has clearly gotten a bid. You could see that clearly within the dollar. So I think that's sort of been the important message is you don't want to go all in or all out on one particular asset class at the expense of the other. And we're sort of living that in real time, especially over the past 5 days.
We're going to get some jobs data today that is going to be an important data point for our Federal Reserve. How do you think the Fed is going to be taking in some of this economic data that's going to be coming?
So, I think that they're increasingly in a tough spot in the sense that I think it's getting just harder to argue for cuts in this environment. And, I was listening actually to Claudia Sahm. I know you're going to have her on, but most recently, just a few minutes ago, talking about sort of this kind of tricky nature of where inflation is, averaging closer to 3%. But the fact that, we'll see what happens at 8:30, there is some stabilization happening in the labor market. And if you take out the federal payroll data, the private workforce in payrolls has been rebounding in a pretty meaningful way over the past several months. So I think that it's a good thing from an economic standpoint. But I think that is sort of keeping the Fed in a really tough position, especially if it's Warsh coming in June and still, tilting dovish. I just think that's going to be tough, at least in the first half of the year.
Across the nation, worldwide, on YouTube, subscribe to Bloomberg Podcasts, our number one way to get in touch with us here on a daily basis. Kevin Gordon of Charles Schwab with us this morning. Oil, $89, really right out to new highs here off of the war, and we're seeing it in futures negative 43 as well. Buried in your note, you're starting to rationalize, and I'm just seeing this in the last 48 hours, Mag 7 may be showing signs of life. Is that the right way to look at the beleaguered tech area?
Yeah, I think, you go through these cycles now every other year, it feels, where you get sort of this big sentiment washout for a group like the Mag 7. I would expand it to, beyond just those 7 names and probably include, all 3 sectors, really: communication services, discretionary, and then tech. And, as I mentioned, we're sort of one headline away from, a lot of this momentum reversing where oil prices come lower for some reason because of a ceasefire announcement, maybe. Not saying that that's our projection. But those kinds of swings in this environment where sentiment has now gotten so stretched in one direction for an area like software and the broader tech sector, and then vice versa for some of these deeper cyclicals like energy, sometimes you sort of have to pay attention to what could snap in terms of that anti-momentum trend.
Paul, Richard Bernstein, iconic at Merrill Lynch, just absolutely wonderful. Great books on growth and value. Leading indicators continue to show strength. Probabilities and timing of Fed rate cuts increasingly seem too optimistic. That's the underlying percolation here.
Absolutely.
Of the economy.
Kevin, earnings were pretty much through the earnings cycle. Pretty darn good earnings. The outlook, maybe a little conservative by a lot of companies, understandably so here. How is the earnings environment out there for you guys as it relates to, can it support this valuation?
Yeah, I think so. And I think, a lot of the valuation excess that has come in and that froth that has come in has been concentrated in some of these higher flyers that tend to be, overvalued relative to the rest of the market, or have tended to be overvalued relative to the rest of the market. From an earnings perspective, I think this is a really central piece of talking about this conflict or any sort of geopolitical instability we've seen this year. The sort of framework that I've used to help kind of guide through this environment over the past year, you can really date it back to Liberation Day, has been the distinction between what is a front page risk and what is bottom line risk for the market. And, we often get the question. I was just speaking at client events in Southern California and also Vermont over the past week. And there's this sort of discomfort that people have around how is the market just completely looking through this? The S&P 500 largely unchanged over the past several months. And to me, from an earnings standpoint, until this materially starts to hit bottom line estimates for the S&P 500, you're not going to see as visceral a response from the S&P. So it's an uncomfortable way of thinking about it because of the humanity angle to all of this. But if you're looking at it dispassionately like the market does, it's an important distinction.
If you go from Southern California to Vermont, do you demand Liz's Gulfstream?
No Gulfstream, no. We are commercial.
How in God's name do you get from Southern California?
Well, I had to stop
Vermont?
over here, so I stopped in New York first, and then I went over to Stowe.
Vermont during ski season. I see what's happening.
Excuse me. Now that we're here, Kevin, can we pause? Pray tell, how are snow conditions in Colorado?
Well, I'm heading out to Colorado Sunday. They're not great, but it's still the Rocky Mountains, and we'll take it.
Better in California, honestly.
I know.
I was just there, and my friends
dumped on.
Yeah, it was.
My cohort, they said, hey, let's go to Japan. That's where the snow is. And I'm like, I'm not going to Japan.
What's a lift ticket? I looked at a lift ticket at Bristol Mountain in Western New York. Big drop. Tiny mountain. $100 a day, prime time.
$325.
$325.
Imagine taking a family skiing like my dad did back in the day. Forget about it. Kevin, what's screening well for you guys these days, whether it's an industry or a factor? What are you guys talking to your clients about these days?
Well, the factors and some of the sector skew in terms of what looks good moving forward are actually somewhat aligned in terms of a lot of the earnings stability coming back for, I call it the rest of the market. So everything except those hyperscalers and the sectors that they occupy. So, with whether it's industrials, which has actually shown pretty solid broad-based strength recently, or even parts of communication services. That's a very, very concentrated sector. I mean, Meta and Alphabet make up about 80% of that.
Yep.
Of that. So it's a pretty, that we always sort of make that distinction. But everything from an earnings stability and profit margin stability standpoint, those are the factors that we've continued to emphasize. And again, similar to diversification, sounds boring when you think about it, when you talk about it, but in this environment where you've got so much potential for whiplash, it really matters in terms of keeping stability in a portfolio.
Do you guys have an S&P target?
We don't. We don't do that.
You don't do that?
No.
Lucky you.
Lucky us. And lucky our clients, because I don't know with 40 million clients, I'm not sure how that's helpful.
The magic of Schwab. What are you hearing from retail Schwab across this country?
So, in all the events I've done in the past couple of weeks, there is still this, and I think it is actually in somewhat keeping with what we've seen in the inflation data year to date. Some more evidence of this tariff pass-through, but there is still more of this consternation and discomfort around what are prices going to look like this year because the general public has just not recovered.
So my brain's going, nominal GDP will hold up, whether it's lousy real GDP 2%, whatever. You throw on a 3% or plus inflation rate, and that's enough to have corporations keep going.
Oh, yeah.
To have revenue?
Yes.
To have earnings.
But admittedly, though, with the split between large and then small and medium-sized companies, I think that I know it's an overused term at this point, but the nature of that K, how you sort of describe the economy, it is still very much there. I do think that because of what happened with labor last year and how much companies pulled back on hiring, especially at the smaller end, there was net negative hiring for small businesses in America. That did help sort of cushion some of their profit margins, and now I think that is benefiting some of their forward earnings estimates.
Paul, Walmart, the last 12 months, you taught me to look at this on the DES screen, up 31%.
Yep.
Right now, the PE is 48. Walmart.
For a retailer, it's more than that.
I would have flunked CFA if they'd asked me that question.
I know, absolutely. So, Kevin, we have seen, I guess, since late last year, a rotation in this market away from some of the growthy sectors of the market into maybe some more value, maybe even small and mid cap. Is that a short-term trade, or is that something that you guys think has maybe some legs here in it?
No, we think it has legs. I mean, admittedly, and we always make the clear sort of distinction that it's never going to happen in a straight line, of course. You're kind of learning that over the past couple of days. At times, small caps are getting hit harder than large caps, as an example. But I think of it kind of in a broader context, not just small versus large in the U.S., but ex-U.S. versus the U.S. Of course, there's been more pressure in the past week in areas like Europe, as I mentioned, with their energy exposure to the Middle East. However, I do think that if you look at some of the PMI data and look some of the economic data around the world, even for the global composite PMI that just came out recently for February, the strength in Asia Pacific and Europe has been, it's been better than the U.S. They've been stronger, and they've seen, stronger accelerating rates of growth. So I think that you have to sort of pay attention to that it's not necessarily just a weaker dollar story. I think that was kind of a 2025 story. Now I think it's translating into sort of more tangible growth prospects for the rest of the world. Not saying that it's this boom, but the market's going to trade off of those rates of change and differentials.
What does earnings season look like? I mean, we're upon the end of the calendar quarter here, March 31. I guess April 20th, April 15th, we start to go through the ballet again.
Yeah.
What's it look like?
Well, I think that the focus is still going to be because of how much we're in this sort of AI-centric economy and market. Still, I think the focus is really going to be, again, on those hyperscalers and how much they're going to up their CapEx budgets. Because that was really the decisive turning point for this rotation last October. When we were in that earnings season and you started to see those announcements roll through, where they started to add up to a third of S&P 500 CapEx, that's when the rotation really started to kick into higher gear. So I think that is still going to be a focal point for earnings.
What we've seen in sell-offs before is Schwab customers stepping up and buying the market, retail buying the market. Retail buying the dips. I mean, so when you go out to Southern California and to Vermont, do you get that sense that your clients want to buy dips, want to continue to be bullish?
I do still get that sense. And I think a lot of it, and I know we talked about this last time that I was here with Lazard and we all had a conversation about this. I think that still the fact that in the post-pandemic era, we really haven't had what I think of as a real bear market.
Right.
And I think it's more important in terms of duration, not necessarily depth. And I think actually the nature of that, the fact that the bear markets we've had have been so short and relatively short-lived, that has sort of conditioned the average retail trader, and especially the newer trader these days, or newer investor, to sort of step right in when you're down 20 or 25%. So to me, the next time we do get a bear market, if it is more protracted, and if it lasts longer, and it's associated with some economic pain, that to me will be the real test for that cohort of traders.
Thank you for coming in.
Thank you for having me. It's always good to see you guys.
Great way to get started. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Brian Gardner joins us, Chief Washington War Policy Strategist at Stifel, with all his work at Keefe Bruyette and Woods over the years. Wonderful to have you here. I heard a group.
I think we're going to go Mr. Gardner first.
Oh, okay. Excuse me.
Let's do that, because let's get the policy stuff right out of the way.
Oh, I'm sorry. Brian Gardner with us. I'm confused here because it's Jobs Day. I'm confused.
We got a lot going on here.
Brian Gardner with us right now. It's Stifel. Brian, I look at where we are, and there's this confusion over conflict and war. It's Stifel. Is this a conflict or is this a war?
I'm not going to speak for the firm, Tom, because I'll probably get myself in a little bit of trouble. But I mean, I'll use the president's words himself. He's referred to it as a war. I mean, obviously, there are folks up on Capitol Hill that want to avoid that term. But the president on several occasions has said, I got to get back to the war. So when bombs start dropping and people are being killed, it's a war.
Hey, Brian, politically speaking, is this war a net positive or net negative for the president here? Because this is a president that, at least in his first term, said he doesn't want anything to do with any of these entanglements.
Yeah, so we're in the fog of war, so it's tough to see forward and how this is all going to play out longer term. But I think there is risk longer term. Short term, there's not a lot of risk. Right now, write down political partisan divides on support for the war, but longer term, he does have to be careful that part of his coalition, more than just the America First diehards, start to peel away. If there were to be boots on the ground, now we're not close to that. The administration has really pushed back on that idea. But if somehow things were to change and there are boots on the ground, I think the political dynamic changes. And he just runs the risk generally of being seen as being too focused on foreign policy when Americans clearly want a focus on economic and domestic policy that goes back to 2024, and it is still the case today.
And Brian, what we saw in some of the governor elections last year in Virginia and New Jersey and some other places was affordability was issue number one. And we're hearing reports that gasoline prices are really starting to surge across America, 25 cents a gallon higher just in the last week or so. That can't be politically good for this administration or the party in general.
Exactly. Look, if this is, sorry to use the word, if this is transitory and markets correct and oil drops back to its previous level and gas gives back its gains, that's one thing. But if this is longer lasting, that's a problem. And just going back, since you mentioned those elections in November, I mean, keep in mind the context of that, not just the shutdown, which everybody pays attention to, but the president had been in Asia before then. And I think, again, it kind of reiterated this perception that maybe he's more focused on foreign policy than domestic policy. I think that's a real risk for him.
A wonderful half hour for you folks into the Jobs Day in 25 minutes. Claudia Sahm will join us to give you that great coverage we try to do for you with the release of the data. Eric Van Nostrand with us shortly, Chief Investment Officer at Lazard Asset Management. Right now, Brian Gardner, Chief Washington Policy Strategist at Stifel. Fold in the elections of Tuesday. I guess the elections for the mid-year started this Tuesday with all that we saw, particularly in Texas and the Carolinas as well. Brian Gardner, is the election season rushed now with all of our uproar? In March, are we doing a May or June fever of a midterm?
Yeah, it just feels, Tom, that every cycle starts earlier and earlier. I mean, I'm already getting questions about 2028, much less the midterm. So we're already into the cycle, especially the midterm cycle, and that's going to flow through to Congress and legislation and what cannot get done. The legislative window is narrowing; it's closing much faster than we have seen in the past. So we are deep into election season. Inside
the Beltway, who has the most money? I'm lectured that money matters. Gura does this. He tells me this. Bloomberg This Weekend with David Gura. Look for that here tomorrow. I mean, help me here, Brian. Who's got money up to the eyeballs?
It matters until it doesn't, Tom. I mean, we can go back and look at a couple of campaigns that have already occurred. The notable state legislative election in Texas a couple of weeks ago, where a Democrat won the seat, took it from Republicans that had held it for quite a long time. The Democratic candidate was outspent 10-1. So, I mean, you have to match the message in the moment. Money matters. Directly to your question, both parties have more than enough money. I think Republican parties, the party apparatus is in really good shape compared to Democrats who, the DNC, I think is not in a good cash situation. But at the candidate level, I think Democratic candidates are in very good shape, especially in those key swing districts. They're flush with money. They're going to have enough. But I think money matters, but I think we overplay it. It's more about the message and the moment.
Brian, most folks feel like the House is certainly in play. How about the Senate in terms of the Democrats taking control?
So Democrats would need a 4-seat pickup in the Senate. And numerically, they have the upper hand because Republicans are defending more seats than are Democrats. So you say, okay, they have more pickup opportunities. But when you look at where those seats are, where the contested seats are, Republicans are in a much stronger position in the Senate than they are in the House. As we sit here today, Paul, I would say Republicans have a pretty good chance, certainly over 50-50. I'm putting it probably in the 60, 65, maybe 70% chance of retaining the Senate. Let's see how the situation with Iran unfolds. Let's come back in 3, 4, 5 months. Yep. It could be a different environment, but based on what we know today, even with a tough political environment for Republicans, I think they're in a good position to keep the Senate.
Brian Gardner, thank you so much. Chief Washington Policy Strategist, Stifel. Greatly appreciate that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.